Hi everyone, in this video we are going to start looking at how we are going to actually record the bad debt expense and write-offs related to accounts receivables. So in this example we have a company operating for 2 years starting in year 2000XX, and they have some credit sales, some write-offs, and some collections, and they are estimating that their bad debt expense is going to be 1% of their credit sales. So the first thing we are going to do is, when we have a credit sale, we are going to increase our accounts receivable, and we are going to record this as a revenue. So when we make a credit sale, we are making some revenue, and this is revenue in year 20XX. By the time we have that, let's make that a bit bigger. By the time we have that, we need to estimate the bad debt expense associated with that, so we can capture the expense associated with the revenue in the same year. And we are told that the company is estimating 1% of their credit sales to be uncollectible. Now, they don't know who is not going to pay and when the write-offs are going to come in, but they know based on historical 1% of their credit sales is uncollectible. So the first thing we are going to do is record associated bad debt expense with that. So expense is going to decrease retained earnings. So this is bad debt expense. So this piece right here is bad debt expense, and we are going to increase the contra asset account called allowance for uncollectibles. So allowance for uncollectibles is going to play as a buffer between what we are estimating that we can't collect versus the write-offs that we are going to actually come in. Now again, why do we do that? Because we want to match the revenues that come in that particular year with the expense itself. And since write-offs are going to come in, part of it in the same year and part of it in the subsequent years, and since we need to close the books at the end of December 31st, the year 20XX, we need to estimate the bad debt expense. That's why we are going through this route. The intuition tells, whenever there is a write-off, we need to write that as an expense. It doesn't work in accounting that way. We need to estimate it just to match the revenue associated with that. Now, when there's a collection, it's going to decrease our accounts receivable, and that's going to increase our cash. And the last piece is write-offs during that year. Some of the write-offs are going to come in that particular year, and when the write-offs come in, we are going to reduce the contra asset account by the same amount. And we are going to repeat the same process for the following year. So when we have a credit sale here, we are going to record it, and then we are going to record the revenue as such. The expense associated with this is estimated to be 1% bad debt expense. We are debiting retained earnings because it's an expense. We are crediting the contra asset account by the same amount. Then we have collections associated with this. So collections are going to come in. That's going to decrease our accounts receivable, and at the same time it's going to increase our cash. Now the last piece is the write-offs. Now the write-off, this part here, some of it is going to come from the credit sales here and some of it from here. Since part of these write-offs are coming from here, as I mentioned, by this time we close the books and we can't go back, and we need to recognize the expense associated with the credit sales in that particular accounting period. That's why we are doing this counterintuitive way of estimating the bad debt expense and then writing the write-offs as a result. Now Hopefully this will give you an idea of why we are doing bad debt expense versus write-offs and how you record accounts receivable in this particular range.